right, guys, welcome back to another episode of Sky's the Limit Podcast. I am your host, Mike Doherty, and today we have Ashley Romiti, who is the president of GCA 1031, specializing in 1031 exchanges, which we've talked about before, but more specifically, Delaware Statutory Trust, also known as DST investments, and 721 UPREIT strategies. We haven't had anyone talk about DSTs before, so I'm really excited to have Ashley speak about that and how it works and how it can fit into your investment thesis. So namely, she helps tired landlords and real estate investors defer capital gains and transition into passive institutional quality real estate assets. So with that, Ashley, welcome. Thank you for coming on the show.
Thank you. I know it's a mouthful. Once you understand it, it's beneficial mouthful.
So before we hit record here, Ashley and I were talking about our Series 7 and 66 licenses, which you hold both those licenses. I used to hold them when I was selling mutual funds to financial advisors back in the day, which seems like 1,000 years ago. I did let those licenses lapse, unfortunately, but we did, while studying for them, I did learn a little bit about DSTs. Haven't used them personally, and I haven't helped any clients use them. So I'm really excited to learn about how they can work and how I can maybe, refer some clients that, kind of fit that mold to go into the statutory trust. So if you could just give us a high level overview of what a DST is and who the applicable person might be to want to use something like this.
Perfect. Good question. Yeah. So a Delaware Statutory Trust, or a DST, it's essentially a trust that holds real estate. So it can have a 300-unit apartment building. It can have a portfolio of retail or industrial properties. But what makes it unique is that it qualifies for 1031 exchange. So meaning that investors can sell their investment property and go into a DST. The way that they're structured is that investors come in as passive owners and they get passive income. So that's really what the idea of the DST is for. So most of the clients that I work with are going to be like retiring landlords who are just tired of getting the tenant calls or the maintenance calls. And then also a lot of those who have owned real estate for a long time, and they're, with appreciation that we've seen in the last decade, those who are getting relatively low return on equity. That's kind of the mold for who typically invests. But I will say it's expanding.
So how would a DST differ from a traditional syndication?
So it really is on the entity structure. So the DST itself in 2004 was approved by the IRS for the 1031 eligibility. And so typically what we see on the syndications are going to be structures like the LLC or general partners where you can't exchange in and out as individuals. You typically have to do it as all investors moving together. And the DST makes it so that we can have upwards of 500 investors come into one deal. And when that deal sells, they get their pro rata share and they get to go do their next exchange. So it doesn't hold the investors together. It gives them that flexibility to move in and out of these syndication type deals. And then the underlying structure is a little bit different too. We don't see the waterfall structure. It really is, you come in, if you invest $100,000 into if you invest $1 million into a $100 million property, you're 1% owner in that real estate. So you get those same benefits. So it looks different than your typical syndications.
Okay, that makes sense on the syndication side. How is it different than a REIT?
Yeah, so I get that a lot because people want to exchange into the REIT, which is where the 721 UPREIT comes in. But in a DST, when you come into the DST, you're a fractional ownership. You have fractional ownership in that real estate. Whereas a REIT, or real estate investment trust, what happens when you invest in a REIT is you're buying shares of a company. So because it's structured as you're buying shares of a company, that alone does not qualify for the 1031 exchange, right? Because it has to be investment property or property for business use. And so the DST qualifies, the REIT doesn't qualify. We'll probably get into it. There's an avenue to go from the DST into the REIT using two different tax codes that you can eventually get into that REIT though.
Okay, so if I'm a tired landlord and I'm selling all my property and I want to identify and identify another investment opportunity, but still meet the 1031 IRS requirements, my choices are I could go into a DST and kind of just let you guys handle that. Other different DSTs. Like when I think of a DST right now, and again, this is just me being small minded. When I interview a lot of people on the podcast that do syndications, and so there's different operators, and they're operating in different markets
Yep.
of the country. I can kind of pick and choose what operator, what sponsor I want to go. I want to invest my capital in, and that I think would satisfy a 1031 exchange. If I'm not mistaken, could I invest in a syndication and satisfy 1031 or no?
It depends on how they've structured it.
Okay.
Um, it gets a little bit more tricky, especially when you're looking at the exit. But
Okay.
the
So it's not as
DS,
clean.
yeah, and a lot of them don't allow exchange funds in because
Okay.
if they might be pulling it together as an LLC, so you can't structure it like that because when you do the exchange, the underlying entity or the taxpayer has to stay the same.
Understood. Okay. So like a syndication where I can pick and choose which people, which syndications I want to invest in, can I choose which DSTs I want to invest in?
Yeah, yeah. So I'll give you a broad overview of what the DST market looks like, what investors
Yeah.
experience when they want to invest. So DSTs are securities, right? So there are a limited number. Today there's about, let's call it, 50 to 60 active DST sponsors. So those are the groups you were talking about that you can invest with, and typically around 90 to 100 different offerings. So an investor theoretically could come in with $1 million, and the minimum in a DST is 100,000. So they could invest in 4 or 5 different DSTs. So they can construct, and this is one of the huge benefits of DSTs, is that you can construct a portfolio where you're invested in maybe 3 different asset classes in 4 different markets with 4 different sponsors. So when we're talking about the retiring investor and we want to mitigate risk, this is a great way to do that because we can construct those portfolios. Now, what I will say is, right, there's 50 to 60 or sponsors, 100 different offerings. Where I come in or where representatives come in is that I'm essentially a DST broker. I help investors structure those portfolios. Just like when you look at different groups, sponsors, not everyone's the same. Not everyone has the same track record. They don't underwrite the same. And with the DST structure, there are some limitations within it. Like you can't raise capital, you can't refinance. And so when we're looking at deals, you want to do a very strong due diligence. They are liquid too. So once you're in, you can't get out. Um, so what I do is I help investors understand this market, and then I really narrow down to a much smaller subset of those larger investment opportunities, and I present those to clients, and we construct a portfolio with those. But it gives the investors the flexibility to come to me and say, I really want a portfolio. I'm moving to Florida. Excuse me. I want a portfolio that favors that tax treatment versus being like I'm in California, right? We're a high tax bracket. Or I want something that's more towards multifamily. Or if they don't know, that's where I would talk to them and I say, okay, what are your goals? Let's put together this portfolio. But it's similar to what you've experienced with the syndications. It's just on a smaller subset of sponsors and properties.
Yeah, makes sense. Wow. Um, what would you say? Yeah, so basically the people, this we'll call them the sponsors, hire you and your company to go out and kind of find them investors, so to speak. And what you're doing is kind of playing the role of financial advisor, which is why you need your 7 and 66. You're going out and listening to investors like myself that's tired I have a large amount I want to invest, but here are my specifications, here are my requirements. You take my temperature, so to speak, and my risk tolerance, and you say, okay, based on what you've told me, I think you'd be a good fit for this DST, this DST, and this DST, but I don't think you'd be a good fit for these reasons. And you kind of pivot or help guide me, let's say, in the right direction of the DSTs, and then I can maybe be introduced to those sponsorships.
Yeah, so exactly. We understand what are your income needs, what are your debt requirements, how old are you, right? Do we need a hedge against inflation? And then once we understand that, we put together the portfolio, and we, like in my firm, we help you with the investment paperwork. So when a client comes to me, they say, Ashley, I just sold a property, 1 million, 2 million, 3 million, however much. There's the minimum's 100,000. So let's say they sell it for 2 million. We get a gauge, what's your total net worth? What's your investment portfolio look like now? And we construct that. And it's, if you've ever done a 1031 exchange, the timeline is really tight, right? You have 45 days. So what's nice with the DSTs is you can narrow down on what you want to invest in even before you close, like 30 days or 20 days before you close. When you close, you can be invested in a DST portfolio within 5 to 10 days.
Wow,
So
that's
it makes it,
huge.
if you're in an exchange, especially in today's market where it's, hard to find good deals, or there's not a lot of good deals out there for the type of client that I'm working with, the DSTs are that solution. It, provides a diversification, the passive income, quick closing, a lot of benefits, risks too, right? I just have to poke at that, right? They're a liquid, investors give up control, and there's no guarantee it's still real estate.
Yeah, no, I could totally see it working for, to your point, you have 45 days to identify, 180 days to close to satisfy your 1031 requirements. So that's a very strict and short timeline, I'll say. So for those that have sold a portfolio and have something identified, they could have the DST on the back burner in the event that they can't buy this replacement property. So they're not losing out on those they're fully 1031 those capital gains. Do you ever see anyone um, do you ever see anyone coming into it? So first question is, what's the lockup period for a DST? Like, what is the investment horizon typically?
Yeah, and this is very important to understand. So typically what I tell clients is 5 to 7 years. It can
Oh, wow,
be
that's
more or
long.
less, and there's different variables, but you want to project that you're going to be in the deal for 5 to 7 years.
Can you pull out your capital sooner than that, or
No,
likely
so
not?
as of today, there's no secondary market. The only time that I have seen or that I've heard of a secondary market is typically they're asking for investors to give a pretty deep discount, upwards of 30 or 40%. So I tell clients, do not go into this unless you can be in that hold period. Um, that 721 that you mentioned, that's a strategy where you go from a DST to a REIT, or a real estate investment trust. It's a shorter time frame. Typically, you go from the DST to the REIT around year 2 or 3, and you're in for the first year, it's typically illiquid. After that, you have liquidity. So for any clients who need future liquidity, I say, let's talk about the 721.
Hmm. Do you ever see anyone come into a DSC to satisfy their 1031 needs, hold for that 5 to 7 year time horizon, and then 1031 back out of it into real property?
It's a conversation I have a lot, and I've structured a lot of clients' exchanges to prepare for that. But I will tell you, typically, what we see is you when a client exits, right? They're 5 to 7 years into never getting a tenant call. They're just getting uh,
Yeah, right,
direct deposit. So once you get a feel for that, and then you say, "Hey, let's go look in the market," and you're going to get hands on, right? Like it's
right, right,
most
right.
investors don't want to do that, but I'll tell you, if I structure them that way. We just haven't
Yeah.
seen it happen.
Yeah, no, it totally makes sense. I was just curious. Let's say you have it invested for, I'm 33 years old. I'm probably not your client for a DST, but I know people that would be. But let's just say I had 100 grand liquid. I needed to put it to work. I couldn't identify a property. Let's say I sold the property, 100 grand capital gain. I wanted to 1031 exchange that. I didn't identify anything rather than paying capital gains. I was like, hey, Ashley, let's invest 100 grand into one of your DSTs. Okay, great, Mike. I still have a longer investment horizon than some of our retired clients here. So 5 to 7 years from now, I might identify a great triple net lease building I want to invest in. I could do that essentially.
You could. I will say, typically when clients are younger, and I always ask someone how old they are because it plays a big
Yeah.
role in how this strategy fits into your exchange. When I started about 15 years ago, retirement age was older than, now I work with clients in their 50s, 60s who are looking at and planning for retirement. Um, but for those who are younger, they're still active. A lot of times it is that I've got a couple 100,000. There's nothing I can buy in the market. Let's place it in a DST and we'll see what happens in
Mm.
5 to 7 years. Or an alternative that I'll just touch on real quick is oil and gas investments qualify for an exchange. So that's a big avenue that I look at with those who have those smaller portions. They're younger, they typically want higher returns. Oil and gas delivers that or projects to deliver that. So we might look at that. I just bring that up because all these strategies, right? I said there's 100 offerings, there's 50. There's a lot of different DSTs aren't a kind of one size fits all, and that's what's important is pinpointing. Okay, where are you at in your investment career? What are the goals? Where do we want to be in 10, 20 years? And that's what we look at for the portfolio today.
What's an average return look like for a DST?
So
Annualized
DS
return.
Yeah, so DSTs today typically are going to be 4 to 6%. And what they follow is